To me, the elephant in the room is Donald Trump, and given that he's totally unreliable in terms of what has said his policies are, what he's going to do, and he has no experience in government and so forth. What impact do you think that might have on our investment strategies in the Australian equity market in particular?
So the question, members of the panel, is the Donald Trump factor. What impact should we have, or should we just totally ignore the Donald?
Trump, yes. I don't think this is a case where you have to act straight away. The market's actually very good at pricing in the fallout from these sort of events after the fact. Pre the fact, the probabilities weren't very good, but that's because the data going into the probabilities wasn't very good. After the fact, I'm not sure as investors we can do better than what the market's already saying, and the market has moved quite decisively. So bond yields have changed direction, and interest rate sensitive stocks have changed direction. I think that's very accurate. That's probably what I would think as well. If you're invested in these really high yield sort of bond proxies that people are calling them, the sort of Transurbans of Sydney airports, so these very high yield stocks, you should be aware that the prospect of higher interest rates has probably been accelerated, and that will affect the valuations of those sort of companies. That's already been, that has already started, and I don't think you can really act too much now to save yourself, but I'd watch the portfolio limits on those sort of businesses and make sure you're not overly exposed. I think that's the big impact. There's probably lots of other secondary impacts that we won't know until he gets into office and actually does something. But the markets are very good at unpacking what the impact of these events is going to be. So I just caution that trying to second guess what bonds and currencies are telling you is not a very productive way to go.
Thanks, Gaurav. I felt a bit like Donald Trump as I was standing in the background there during one of the debates. Next question, please.
Yes, I have a question for Gaurav. You talked a lot about buying. Could you talk a little bit about your criteria for selling?
We should keep you over here, Gaurav.
Sorry, where are you? That's a really, really important question. And I'd say it's probably one of the hardest things. Buying is a very specific skill set, and we train ourselves a lot to get good at buying. I think we're pretty good at it. Selling is a completely different skill set, and it takes a different psychology and a different method to get good at selling. And we've recently worked very hard to improve our selling criteria. The best way, the way I think about it is every time I buy a business, I know beforehand what I think it's worth. And as the price approaches that value, we try and take some profits. This is the way we work in the portfolio. So we recently took some profit out of South 32. I think we bought South 32 in the growth and income portfolio, sort of between 170 and 120, and it's now about 280. And we recently just started taking a little bit of profit, even though our official sell guide is about 350. And we did that because prices are approaching the point of full value, and it's probably too late to sell. It's not too late. It's a little bit risky to sell bang on full value. You want to sort of be selling as you're approaching full value, especially if you've made quite large gains on a stock the way we have with South 32. So that's probably the best response I can give you for now. But it's really good that you asked that question, and it's a super important part of investing that probably doesn't get covered enough, is having a disciplined selling approach. And the way to cultivate that is to have an idea about where you will sell or where you'll start selling at the same time as you're buying the stock. So every single stock in our portfolio at the moment, we have an idea about where we'd start selling it, and we have sell targets for it. It really needs to be part of your initial buying approach as well.
Regarding property, with property you're referring to direct property holdings or listed companies, and by property do you mean all property, retail, industrial, commercial?
So,
the whole lot? You'd lump it all together?
yeah, so in our portfolio manager, looking at asset classes, we look at property, whether it's in a fund, whether it's in an AREIT, so we look at all the funds you own, and then we have a look inside of that fund and go how much is in property, how much is in cash, and we add all that together. That creates your whole asset allocation pie chart. So we look through all of that. What you can do in the portfolio manager is exclude your residential property if you've got that in there, or you can include it as well if you want.
Yes, Ron, during your presentation you spoke about rebalancing the portfolio across a number of years towards asset allocation weightings. My question is, would those weightings have changed over the years of the simulation? And secondly, how do you decide, for example, for a given risk weighting or risk tolerance, that 30% international is the appropriate figure, for example?
So we continually change our own internal asset allocation for what we compare your fund against, or what your portfolio is against. So that will affect your health check. So we, as we go along and we get out of sync internally with our own internal asset allocation, we change those, and so that'll have an effect on your portfolio. How we choose the asset allocation is the first one is between income and growth assets. So it's between income and growth assets. So, balanced is traditionally 50-50. And so that's fairly universal, 50% income, 50% growth. But that's not the sort of secret sauce. The secret sauce is underneath that. When it comes to income, what should you tactically allocate your funds to inside of income, so cash and fixed interest. And then inside of fixed interest, is it commercial, is it government, corporate, is it local, is it overseas? And so that's where we do our own valuations internally to work out our tactical asset allocation. Does that answer your question?
So what's the basis for making those percentage weightings?
The percentage of the tactical asset allocation? We have a look, there's a number of things. One is we have a look at all of our peers. So we continually look over about 8,000 different funds and see where they're asset allocated. And then we decide whether we want to go overweight or underweight given the benchmark. Because remember, we're doing index funds. So we're having a look at what the index, so for example, international equities, we look at, because we benchmark our international equities against the MSCI, we have a look at what the MSCI's asset allocation is. And then we tactically go, do we want to be exactly the same as MSCI? Or do we want to be, underweight US equities? When we say underweight, by the way, we're only talking about 1 or 2%. We're not sort of like going, we've got no US equities at all. We just go a little bit underweight, and then where do we put that money? We go a little bit overweight in Europe and emerging markets. We see better value in those ones. So it's where we see value. But the first and foremost, we look at the market itself, our benchmark, because we're benchmarked against MSCI or against, for our diversified funds, we're benchmarked against Morningstar multi-sector growth, or multi-sector conservative balanced growth and high growth. So we have a look at all those 8,000 funds that make up those benchmarks, and then we work out where we want to go overweight and underweight, if at all.
Hi there. Ron, you mentioned the many benefits of rebalancing. How often would you recommend rebalancing your portfolio?
And for example, I just sold my unit at the beginning of this week, and especially direct property, there's transaction costs, which, everybody sort of like is nodding going, I'm overweight property, but it's going to cost me a fortune to get out of it. So you can't, and the 100% correlation I sort of like was saying, it's the whole idea of the tool is not to be 100%. It's just to give you an idea of what your asset mix is compared to what your risk appetite is. And you need to be comfortable with that. So it's a sort of a question for everyone. I took 2 years to sell a property. Even though probably 2 years ago I had the same belief. Luckily I didn't, because 2 years later I probably did a bit better. But I think, going back to Gaurav and the Trump question, interest rates are going to go up at some stage. There is more risk that interest rates will go up than go down. I don't think anyone in the world is probably going to battle me on that one. So it's when you think And if you try to time the markets like Mitch says, you most likely will fail. So it's a hard question, and it's really for each person to work out when they want to actually rebalance. But the cost of rebalancing needs to be taken into account. And some asset classes are easier to rebalance than others.
Up on the board, I noticed that there was WAM up there in terms of scale, and also it was the best in terms of turnover. You didn't mention it once, and I'm just wondering why it didn't seem to rate with you.
The WAM funds are, they've been really good. The LICs that Jeff Wilson and the team there run have been really good for a very long time, and so they've probably earned themselves a premium to their price to NTA. In the listed investment company model portfolio that I've been looking over on the Eureka Report website for some time, we held WAM Research. And the reason for that is I felt more comfortable with the research aspect of what those guys do. The WAM Capital, the big one, which is the most liquid, and it's the most heavily traded because it's probably the most widely publicised as well. Jeff Wilson is a publicity machine. He is not afraid of a camera or an event. But that particular fund marries his two trading mentality and a long-term investing mentality. I wasn't overly comfortable with the trading aspect. But if you look at it, I think these are just rough numbers off the top of my head. They're trading at about a premium of about 30+% each, and that's I don't think that's sustainable. I think that'll come out. And that's why we removed WAM Research from the portfolio. It was trading well and truly above its NTA. It'll be difficult to buy the WAM funds at NTA or below, because an extreme event will have to take place to get them there. But you want to be looking at something like that well below NTA, because the fees and performance fees that are charged within that vehicle, you're looking at, if he's taking out performance fees, you're looking at an MER of roughly around 4% or so. So you need to be looking at a discount to NTA to justify that. But it seems like at the moment plenty of people are prepared to pay up for those, but just not myself.
Being investors, we are our own worst enemies at times. You've discussed what we need to have. We'd all love to make 30 or 50% or something every year, but that's not going to happen. What I'm trying to say is there a set of rules or questions where we can self-evaluate our own risk, ability to cope, etc.? And sort of as a second question, if there's a market that we don't know, like international equities, how do we brace ourselves to know what we should be doing in that area? In other words, why should we be, or what's our risk profile in that area, and how do we go about discovering that?
I actually, before doing these presentations, I sent an email around to all of the analyst team, and I said, what questions would you ask people to determine their investment temperament? And don't hold me to this, because who knows when I'll get around to doing it. But I thought about compiling those into like a little questionnaire type thing, so you can, 1 to 5, tick the little things and you get perhaps a score. But that's something that I've considered doing, because I don't think there's, to my knowledge, anything out there at the moment, but you can feel free to email me and correct me. But when it comes to, say, investing in markets you don't know, Buffett always says invest in your circle of competence. But when it comes to investing in something that you probably should have diversification in, but don't have the expertise, or that's when you buy something that, say, internationally tracks like the MSCI All World Index, where you go broad, basically, to get that broad diversification. Or you go to someone, say like ourselves, we're not trying to shoot the lights out with these products with, say, the diversified portfolios, and we've gone incredibly broad and bought emerging markets, US large cap and mid cap ETFs, European as well. So yeah, that's the only way to combat it, is to, when if you really understand that you don't have any knowledge in that area, you do have to go very, very broad and diversify into an exchange traded fund like product.
I have a question for Ron. You've addressed it to an extent already, but I'm one of the property tragics that you referred to, and I was really surprised to see that you had the asset allocation to properties so low, just 2% even in a conservative portfolio. You know, I've found over my investment life that my little house in Carlton is, you know, it's grown at 8% per annum and it gives me $20,000 a year income, and I wondered why, you know, I'm doing so, you know, I should be down at 2%. Could you just elaborate a little on
so it's going
why
back
that?
to, you know, the other gentleman's question, which was, you know, how do we pick those asset allocations in the first place? And what we do is we look at the entire market and all the funds and see what our benchmark is. So, you know, we've benchmarked, so for our conservative portfolio, we've benchmarked against Morningstar multi-sector moderate conservative, and that has about 500 or I think 600 funds in it. And we have a look at all those funds and see where they are, and then we come back to them. That's where we get that 2 or 3%, and then we work out, and I think we're actually underweight property now, so we've made a judgment call on where we think the risks in the marketplace are. And so similar to what Gaurav has said about, you know, a lot of those yield stocks have already come off, A-REITs have come off, property's already come off. We believe that there is more risk to property on the downside than the upside currently. And so we've gone a little bit underweight property, probably more so than our benchmarking peers. So that's where we get that 2% from. It's a judgment call by us. And again, it's not to say we want everybody to go out and sell their properties and get down to 2%. It's that the tool, and I really want to stress this, the tool is really just there to show you where your risks are. So some people know that they own an apartment and it's worth, you know, $500,000. Lots of other people don't know that they also own 3 other funds, and in those funds own 30% of property. Yeah, and then when they add it all up, they go, I don't have 30% or 44% of my portfolio. A lot of our guys in our portfolio manager would say, I don't have 44% of my property in property. They go, I've only got a direct equities of 1 investment. We go, yeah, but you've got these 4 funds, and then you've got more in there. And that's all that tool does. It doesn't say whether you're right or wrong, it just says that. Then from a conservative point of view as well, if you're a conservative in a conservative portfolio, how our health check is calculated is it takes into account 2 things. One is it takes into account the breakdown of income versus growth. Yeah, and so income assets are cash and fixed interest, and growth is property, shares, international shares, domestic shares. And so you get a score on that behind the scenes, and then you get a score on also your diversification within those asset classes. Yeah, so if you only own 1 stock in Aussie equities, so a lot of people just own 1 stock, we go, well, you're actually, yes, you've ticked the box that you've got the right percentage in Aussie equities, but you only got 1. So then we go, you know, that's not diversified. And so, you know, that's why we've used the II growth portfolios, why we have Intelligent Investor with inside of our group to say, here's some other ideas to maybe broaden your horizons a little bit in Aussie equities. So I still own property. I'm still probably overweight property, but I've reduced it a little bit.
This is a couple of questions, a couple of comments. I've had News Corp for 20 years, and I see you've got it in an income portfolio. Well, there's not much income there. Jeff Wilson, if you ever go to any of his presentations, he puts on a great show. You haven't sort of said anything much about options. Do you use options? And what would you do with the Commonwealth Bank that you bought at $5.40? Would you still hold it?
News Corp we bought for a very specific reason. I agree with you. It's not been a terrific business. It's probably not a terrific business today, but today it's made up of a bunch of very clearly identifiable assets that are quite easy to value. And when we go around and value those assets, News Corp is trading at sort of 30-35% discount to its asset base. And that's a big discount. It's also throwing off a lot of cash. So everyone knows the newspapers and magazines are in decline. What people may not realise is that investment in those properties is also in decline. And so the company's actually throwing off piles of cash. It's got more than $1 billion of cash and generates sort of $500-600 million more every year. And for those reasons, I think News Corp is undervalued today, which is why we have it. Why we have it in the income portfolio specifically is because it has a very high free cash flow yield. Now, the difference between the free cash flow yield and the dividend yield is simply management decision about how much of that cash to pay. So I think over time, as cash piles up in News Corp, there could be a decision there to pay out more dividends. And if that decision doesn't come, then at least you'll have more profits and a larger pile of cash. So you'd expect some reaction in the share price. But I'm pretty comfortable with News Corp in the portfolio. I think it's a strong idea. It's still a buy now. Jeff Wilson, yes, puts on a great show. Agreed. And CBA, a very difficult question. I empathise with that dilemma. It's not easy. I think CBA is mildly expensive. We have it as a hold, but we're constantly arguing about whether to put it as a sell or not. I think if you bought it at $5, you'd be loath to sell it. And that's probably one of the limitations of a one-size-fits-all recommendations guide. You do have to take your own situation into account a little bit. And yeah, I think you're right. I probably wouldn't sell at $5. Yeah. Well, if I bought it at $5, yeah. Oh, sorry, options. We don't use options because they are expensive. Trading costs are extremely high, and they provide leverage, which is wonderful on the upside, but just destroys your returns on the downside. So unless you have a very large degree of certainty and a very careful management system, we don't recommend using them. You have to watch them quite carefully because the position sizes and calls and things like that move around very fast. It's just a little bit too much for us to do, and we make very good returns without the use of options, so stay away from them.
In relation to how your health check app allows for an extra parameter for people with SMFs in pension funds.
I mean, we can talk about this after because I'm unsure of your question, but just I'll give it my best. Our portfolio manager takes into account your risk appetite. It doesn't, and so you can go to your portfolio manager. Lots of people manage numerous portfolios within the portfolio manager. So you can set a risk appetite per portfolio. So some people, so for example, I've got a SMSF, I have a different risk appetite for a different investment goal for that compared to my personal portfolio where, you know, I'd have a really appalling health check on my personal portfolio. I can then add them all together and look at it overall. So we don't take into account what stage, whether you're in pension, superannuation or personal or investment, you set a risk appetite, which is really based on time horizon per portfolio. Yeah. So I don't think, it'd be interesting to have a chat to you. I don't think that our philosophy is, it doesn't really matter whether you're in pension or superannuation or what sort of structure you invest in. It wouldn't affect the outcome of the health check score. Well, I don't think it should affect it. It doesn't, and I don't think it should.